Welcome to the Finance Podcast. The topic of this episode, Liquid Alternatives, the cheapest way to mitigate equity risk by Frédéric Sonney from Banque Cantonale Vaudoise.
Okay, can you hear me? Yeah, it works. Okay, so thank you everyone for being here. At least I'm not alone in the room. I attended the previous presentation, and it was about alternative investments, but I barely heard the word hedge funds, and I even didn't hear at all the word liquid alternatives. And this is clearly what we are going to talk about today. It's liquid alternatives and how it can help you diversify a portfolio of traditional assets in a world where perhaps bonds may not play this role anymore, maybe. So talking about traditional assets, this is our reference portfolio. It's the so-called 60-40 portfolio, the portfolio that invests 60% in equities and 40% in bonds. Okay, and it's a proxy for the typical traditional portfolio that you are maybe running. So in blue, you have bonds since the 80s, so around 40 years of a time period. In green, you have equities. And the gray line is a pretty nice line. It's the 60-40 portfolio. And you can see that it has worked extremely well over the past more or less 4 decades. And there are mostly 2 reasons to that. There were 2 major tailwinds that helped both equities and bonds to perform very well over this period of time. The first one is that since the 80s, rates have decreased, more or less constantly over a 40-year period. So everyone understands that when rates decrease, bond prices increase. So this helps bonds. What is less well understood is that when rates decrease, it typically helps equities as well. And the return of equities over this period of time, which was pretty amazing, was helped by this decreasing interest rates. This was the first tailwind. The second one is the negative correlation between stocks and bonds. Over most of this 40-year period, this correlation has been negative. And in terms of portfolio diversification, this is hugely important. When you combine 2 negatively correlated assets, you get a very well diversified portfolio. Okay? Rates have slightly increased. Okay? They remain low on a historical basis. The correlation, and we have discussed this many times over the past couple of years, correlations between bonds and equities have turned quite significantly positive. So the diversification of your portfolio might not be as efficient as it used to be over the past few decades. Okay? So even in a period like this one, where everything was going well, fine for bonds and equities, and that you can build a portfolio of equities and bonds that perform well and is well diversified, even in such a positive environment, you had quite some significant drawdowns. Okay? These are the drawdowns of the 60-40 portfolio. So you could lose more than 30%. During the great financial crisis, your drawdown was of this type of magnitude. Here we are talking about US equities and US bonds for simplification. So the first question is that, the first question, is, could we reduce these drawdowns? Okay, could we manage to have less significant drawdown? Okay, looking at the past, okay, it's pretty not that useful in terms of what is coming next. But the second question is, based on this evidence, based on this historical evidence, could we build a portfolio that will help us manage a better diversified portfolio with smaller drawdowns? And this is typically what we are going to discuss, and I will propose liquid alternatives as a potential way of diversifying your portfolio, especially if bonds cannot play this diversifier role anymore. So when we talk about liquid alternatives, we mostly refer to risk premia, what we call alternative risk premia. So you probably have heard of value, size, quality, momentum, carry, trend. And trend is the one I will mostly focus on during this presentation. Trend is a subset of this whole universe of uncorrelated investment strategies which are uncorrelated to traditional assets like stocks, bonds, real estate, credit. And the good thing about these types of strategies is that they can act as a kind of hedge, or at least diversify your portfolio, but in the same time, they come with a positive expected return, okay, which is not typical of a hedge. A hedge typically has a negative expected return because you have to pay for this insurance. You have to pay to insure your portfolio. So trend following, as an example of this whole universe of liquid alternative premia, trend following, for those of you who are not aware of how it works, just in a nutshell, this is a stylized, very simple example, just to explain to you how trend following strategies work. Okay? Trend following strategies are systematic strategies, and the objective is to go long when the trend is positive, and to go short when the trend is negative, okay? To benefit being long when prices increase, and to benefit as well when prices decrease. So when I say that I want to go long when trend is positive, short when trend is negative, I need a measure of the trend. How do I say that the trend is positive? How do I say that the trend is negative? And one example, and one of the things that is used by CTAs, or managed futures trend following strategies, is to compare two moving averages. One short moving average and one longer moving average. So you have the short one in gray here, and what you see is that typically when the trend is positive, the short moving average tends to be above the long-term moving average. And when the trend is negative, the short-term moving average tends to be below the long-term moving average. So what trend following strategies will do, typically, is to go long when the short-term moving average is positive, is above the long-term moving average, and to go short when the short-term moving average is below the long-term moving average. And you do this on many uncorrelated assets, and you do this with different measures of trend, managing the volatility of your portfolio and so on. There are some specific portfolio management considerations behind this, and you get something that performs quite well. Okay? This is real-life performance of a trend-following strategy. Not really of a trend-following strategy, it's an index of CTAs. Okay? But this is real-life performance. So you see that since the late 80s, the performance has been quite good. But it's not good all the time. Okay? Here, you have a period of around 10 years where trend-following strategies did not work. Okay? Your return was basically zero over a 10-year period. And this is the main reason why people say that these strategies don't work anymore. Okay? But if you look at some more history of trend-following strategies, this is a figure that comes from a paper by CFM, who is a systematic hedge fund manager, doing precisely this and earning 2 and 20 for those of you who were attending the previous presentation. They look at around 2 centuries of performance of trend following. Okay? And here, the performance is more or less the same as the one I showed you before, with long periods of bad performances as well. So it's not pretty obvious from the figure here, but here, for instance, in the 40s, you had around 15 years where trend following strategies did not do anything interesting. Okay? So here is the same graph as before, with the equities, bonds, the 60-40 portfolio, and my index of trend following strategies. And you see once again that there was this long period of time, this 10-year period, where trend following did not really work, especially in a period where equities had such impressive returns. But this is not the point here. The point is you should ask the question when trend following strategies work and when they don't. And this is the very interesting thing here with these types of strategies, is that they work when you need them to work. Okay, here you have the same graph, the same figure as before, split it between the 4 crisis periods that we've known over this period of time and the rest of the time, okay, when everything was doing fine. Okay, so first one, this 1987 crash, so it was a very short-lived one, where equities were significantly down, and you have trend in blue here, which helped diversifying your portfolio. A longer one, it was the burst of the techno bubble in early 2000. Here, once again, equities, as you know, lost quite significant amount of money, and trend helped quite a lot. Okay? Once again, diversifying your portfolio. The global financial crisis of 2008, once again, trend performed quite well. And in all these 3 occasions, you can also see that bonds, which are the dashed green line, bonds did the job of diversifying your portfolio, which was not the case 2 years ago, one and a half year ago, in 2022, when both stocks and equities were down, and your portfolio, your 60-40 portfolio, was significantly down as well. Okay? This hedging property of trend following comes with a cost. Probably it works, or it seems to work less well when the market goes up. Okay? If you look at the 90s, you had equities with huge returns. The trend following strategy did work well as well, but not as well as stocks. In the 2000s, the performance was positive as well, so everything was fine, but far less than equities when equities are in bull markets. In the period 2009 to 2021, this is the 10-year period where I said before, trend following did not work. And indeed, it didn't work extremely well. You had a return of roughly 0 over this period, as you did over the last couple of years. Okay? And I'm quite unfair with trend following strategies because I stopped here on February. In March, they had a very good performance. Okay? And once again, the same comment as before when I compared to bonds. Here, trend following is not ridiculous if you compare to bonds in every single case. So a hedging property that doesn't depend on the stock-bond correlation, which turned positive in 2022, and of course, a performance which is less interesting in times where perhaps you don't need that interesting performance. Okay? And once again, the idea is to diversify your portfolio. You had a question?
Trend following is always wrong, or does it also go short?
No, this is the main interest of trend following strategy, is that it can go short. And when the trend is negative, as I said before, trend following strategies tend to short the assets which are in a negative trend. In 2022, they made a lot of money on shorting rates, shorting bonds. Okay? Most of their return came from this positioning. So looks like trend following is able to help you diversify your portfolio over the 1987 period to today. Here is a study by AQR, another systematic hedge fund manager, with many very impressive academics working with them. So they do a very good job, quite impressive one. And they look back to the 90s, the late 90s, at all the crisis periods of the 60-40 portfolio. So here you have the returns of the 60-40 portfolio in blue for each of the crises that occurred since 1893. Okay? And in green, you have the return on a trend-following strategy at the same time during the same crisis period in each time. Okay? And except for a couple of crashes where trend following was negative as well, slightly negative, trend following helped in all crises since more than a century ago. Yeah?
I'm sorry if you mentioned it earlier, but what you call trend following, is it for all asset classes or one class?
It is for all asset classes, depending on what you call all asset classes, but they typically invest in equities, bonds, rates, FX, and commodities. And what they are trying to do is to build a portfolio of uncorrelated assets, to build a highly diversified portfolio. So if they can find other asset classes that help diversifying the portfolio, they would add them. One of the trends, it's not that recent anymore, but that dates back to a few years ago, is to include what they call alternative assets in the universe. So AQR, for instance, they have a trend-following strategy in which they invest in alternative assets, alternative asset classes, and what they put in it includes the risk premia, the equity risk premia that they build for their equity risk premia portfolio. I'm not sure it was clear. For instance, they do trend on the equity value factor, for instance. Okay? So as long as you can add assets or strategies on assets with positive expected returns and low correlation to your portfolio, then you're diversifying your portfolio and you're increasing the Sharpe ratio mechanically of your portfolio.
Understood. But on this particular chart, what you call trend following is a mix of equities, bonds, and other.
I don't remember exactly about this paper, but very presumably, you don't have all asset classes from the very beginning of the sample.
Okay.
Because of the lack of data availability.
Sure.
But sure, as soon as they have data, they include in this paper, they include equities, bonds, fixed income, FX, and commodities.
Thank you.
You're welcome.
It's trend following.
Yeah, more like a CTA. Global macro tends to, because a trend following strategy looks only at prices. Okay, you look. The example I gave you before was the S&P 500. Okay, to explain what trend following is. Okay. This one. This is the S&P 500 from 1997 to 2009. Okay? So to build a trend-following strategy, you only need prices. This is the only information you need to measure. You measure the trend of your time series, and you do this on many different assets, and you build your portfolio from this single observation. I mean, only prices. Global macro managers tend to use fundamental data, macro data, data different than prices, in order to forecast the returns on the prices.
So just another question. If you go back to your slide, it's like you telling us that the trend following is a kind of all-weather.
I'm telling you, trend following has worked in almost every drawdown of the 60/40 portfolio over some very long, a very long past period in the history. I also showed you that you better have equities when equities are in a bull market. Okay? If you knew when equity will be in a bull market and when equities will be in a bear market, I would tell you buy equities and sell equities and don't do anything else. If you're not able to forecast bull and bear markets for equities, I'm telling you, try to build a diversified portfolio. A portfolio that doesn't suffer huge drawdowns, perhaps at the cost of some slightly smaller return, not even sure. But in the end, Markowitz said, diversification is the only free lunch in finance. So not diversifying your portfolio would not be that smart. Okay? It's fairly easy to do, and I think everyone should do it. Okay? So if you can find an asset class or an instrument, or in this case, an investment strategy that has low correlation to your existing portfolio, you should really consider this investment.
If you'd have to take the, let's say you only have a specific amount of cash, so if you want to diversify, would you take it from the fixed income part for the trend following or from the equity?
This comes next. Okay, let me show you. This is the question I asked myself, and this is the answer, the best answer I can give you. It comes very, very soon. So here, here, perhaps the most important one is in green. Here you have the 60/40 portfolio with the respective drawdowns on the right side. So this is nothing more than what I showed you before. In blue, you have a portfolio made of half of the 60/40 portfolio and half of a trend following strategy. So 50% in the 60/40 portfolio, 50% in a trend following strategy. Meaning you invest 30% in equities, 20% in bonds, and 50% in trends. I'm not saying you should do that. Okay, 50% allocation to trend following is quite a significant allocation. This is not what I'm saying. I was just trying to show you the impact of adding some trend following to your portfolio of stocks and bonds on your, call it equity line, which is reported in blue here, which is, in my opinion, nicer than the green one. And you can see the drawdowns here on the right of the screen, which are more limited as well. Perhaps at some cost, it's not even obvious, because this cost of roughly 80 basis points per year mostly comes from the latest period, the period that started in 2009, where equities had unconventional, abnormal, exceptional returns. Okay, so it's not even obvious that your expected return in a trend following strategy should be less than a 60/40 portfolio. So here, I allocated purely discretionarily 50% to the trend following strategy. Now, if I'm not wrong, the next slide is supposed to answer your question about how much you should invest in trend and from what you take your allocation. Should you take it from bonds? Should you take it from equities? So what I tried to do here is to ask Markowitz what advice he would give me. So taking the whole period from 1997 to today, I built two efficient frontiers. Okay? I asked Markowitz, what are my optimal efficient portfolios. So the first one is the light gray one, okay, which considers only stocks and bonds. So you go from a lot of US treasuries here. It's not 100% treasuries because you are able to diversify a little bit, but anyway, a lot of treasuries, not that many equities, and you can go up to 100% invested in equities. Your 60-40 portfolio is here. I think I have the... No, I don't. Your 60-40 portfolio is here. Now, if you allow Markowitz to invest in trend following, then your efficient frontier moves to the upper left. And this is precisely what you're trying to do when you build a portfolio, when you try to build a diversified, efficient portfolio. This is, you would like to go as far as you can to the upper left of this graph, or at least to the left of this graph. And the only thing that helps you go to the left of the graph is correlations. Correlations between the assets you put into the optimizer. The lower the correlation, and if possibly negative correlations, the more you will move to the left. So this is what trend following strategy allow you to do. I focus, let's say, on two specific portfolios. The first one is the one that has the same risk as the 60-40 portfolio for an investor who is happy with the risk of his traditional portfolio and wants to have the same level of risk. And the second portfolio is the one which has the same average return as the 60-40 portfolio, okay? For an investor who is willing, who is happy with the return, the average return of his 60-40 portfolio, but who will take the opportunity to take less risk than investing only in stocks and bonds. So these two portfolios here, you have the weights of these portfolios reported here. So you have the 60-40 portfolio here, okay? 60% in equities, 40% in bonds. And this is what Markowitz tells you. Once again, I'm not telling you to do that, but Markowitz would say, okay, over this 40-year period of time, the optimal portfolio, which has the same return as the 60-40, would have invested only 11% in bonds, 45% in equities, and a huge 44% in my trend following strategy. The portfolio with the same risk as the 60-40 would not invest in fixed income at all, okay? You would invest a 60-40 portfolio, but 60% in equities, 45% in trend following, okay? So you'll tell me, okay, but trend following did not work since 2009, so your results are not okay. We wouldn't have been happy with trend following in our portfolios since 2009, so I replicated the exact same analysis, restricting myself to the period 2009 to today. I could have stopped in 2021, okay, because this is really the period where trend following did not work at all. It's quite impressive, the results Markowitz give you when you do that. Markowitz tell you your optimal portfolio is the 60-40, okay? So no need to have anything else. You have stocks with huge returns. You have bonds which are uncorrelated to your stocks. So go for it. Invest in equities and bonds. But the 2009-2021 period is probably not a reliable guide for the future. So I extended a little bit the period to 2023, which includes 2022, which was a year where trend following did help in diversifying your portfolio. And these are the results you get. Okay, so from the 60-40 portfolio, if you want same return or same risk, then Markowitz tells you you should allocate 14% to trend following, and you should take this from the fixed income part of your portfolio, which is very good news in a world with positive correlations between bonds and equities, but this I'll let you make your own opinion. So this was for trends, and the good thing with trend, and the main reason why it helps, is that its correlation to traditional assets is very low. And as I said before, you have a whole bunch of strategies, of investment strategies, which have low correlations to traditional assets. I'm thinking at value, momentum, quality, carry, all these types of alternative risk premia that I didn't consider at all here. So this is what I did next. I allowed Markowitz to invest in this alternative risk premia. Okay, so I still have my US Treasuries, still have my US equities, and my trend following portfolio. I now allow Markowitz to invest in illiquid alternative investments, meaning the HFRI Fund of Fund Index. Illiquid means more or less monthly liquidity, so it's not the end of the world. And an alternative premia product. Okay? A product that does a whole bunch of alternative risk premia, as the one that we have at BCV. So here, I was quite surprised, to tell you the truth, by the result, because I sincerely think that trend is something really, really powerful and that really deserves consideration. And I thought Markowitz would stick to its allocation to the trend following strategy. Where I was surprised is to see the extent to which Markowitz allocates to alternative risk premia. Okay, the whole allocation to the trend following went almost entirely to alternative risk premia strategy. Okay, and the two portfolios with same return and same risk are pretty much the same. And if we briefly look at the most recent period, you get this result that don't really deserve much comment. You have more or less the same allocation to our alternative strategies, with some decent part to trend and a little part to alternative risk premia in general. And this was also a difficult period for these types of strategies. Okay? So if I summarize, I would say that trend following is a very interesting strategy in itself. Okay? It has positive expected return. It typically has high Sharpe ratios, especially when traditional markets are in drawdowns. And this is the reason why it's, I think, a highly valuable addition to a portfolio made of traditional assets. It diversifies your portfolio by reducing its volatility or increasing return for the same level of volatility, by significantly reducing drawdowns, and we've seen that it doesn't penalize return over a long period of time, or not that much at least. We often hear that alternative investments are illiquid, that they are costly. Trend following strategies are available at daily frequencies and at very low cost. So before we mentioned CTAs, okay, this was the hedge funds that were doing these types of strategies, implementing these trend following type of strategies. This is something we are able to do today at very low cost. Okay? This is what we do in our alternative risk premia product. We built trend following strategies that work in line with the index that I showed before, the index of trend following strategies. It is kind of a surprise to me that it's not more popular, that, in my opinion, you should have this in every single portfolio. Okay, so it's somewhat surprising to me that people don't even know about trend following very often. And my two best explanations, perhaps you have other ones, so I take them I would be very happy to take them. The first one for me is that it underperformed over the recent past. And the recent past means 10 to 15 years. So it's a long period of time, I agree. But no one gave up on equities because between 2000 and 2010, 2009, returns were close to zero with huge drawdowns in between. But people kind of gave up on trend following for the reason that it did not deliver over this period of time, which was, by the way, a very difficult environment for these strategies. Okay, these strategies need dispersion, they need volatility, and this is exactly what they didn't have over this long period of time where equities had exceptional returns. And my second reason why trend following strategies are not more popular among investors is probably because over the past 40 years, bonds have made the job of diversifying your portfolio. Okay, you had negative and significantly negative correlations between stocks and bonds, which helped diversify your portfolio. So now I'll let you make your opinion on whether the stock-bond correlation will remain positive over the next decade, whether equities will have such high returns over the next decade. But my opinion is that trend-following strategies and alternative risk premia as a whole really deserve some consideration, or at least some analysis. Yeah?
In your Markowitz analysis, you must input some correlations.
Yeah.
But I suspect there is a good times correlation and a bad times correlation.
You could do this. You can do
You are
this.
assuming a constant correlation over a time period, and that may not be a very good assumption.
No, but Markowitz gives you the best portfolio you would have had over the entire period of time, not knowing when correlations will be high and when correlations will be low, as without knowing when markets will go up, markets will go down. Okay, this is an average. This is you should not take all this as granted and as and invest 14% in trend following because it was written 14. This is a stylized example. This is a simplified example. In real life, you don't only have equities and bonds. You also have real estate. You also have commodities. You also have credit. You also have many different things, even though all traditional asset classes tend to be correlated with each other. Okay, real estate depend presumably on rates, okay, as do bonds. Credit is probably a little bit correlated to equities, and so on and so forth. So here, it's a strategy, a highly dynamic strategy, actually. If you look at the weights taken by a trend following strategy, you would be probably scared. But this is a strategy that can go long, can go short, and in the end, the way it is built provides you, or has provided you over the past century, protection in traditional market downturns. Yeah.
First question, in your analysis, did you consider the cost of actually buying and selling because of the trend strategy? So was it net of cost, basically?
It is, because what I took in my analysis, actually what was not net of cost was equities and bonds. The other one is an index of trend following strategies. So it's net of cost, yeah.
Okay, and the second thing was because the usefulness of this trend strategy changes according to the period. In your slides, you were showing between 15 and 45% as an example, of course. For my question is, when or how do you change your strategy to allocate more or less to trend? Is it only done ex ante, or do you have what? How do you change?
I would let trend do the job of asset allocation. I would have a constant allocation to trend and other alternative risk premia, and let do the job.
You would allocate X% to trend, whether it is a bear market or
at
a
all
bull
times.
market at all
At
times.
all times, because I cannot forecast when the next drawdown will come, when the next bear market will come, and I hope that my trend sleeve, that my allocation to trend, will work out when we are in a bear market that I was not allowed to forecast.
Because considering the big difference in your ideal Markowitz-based allocation, 15 to 45, so 1 to 3 ratio, as an investor, I would like to try to make it more dynamic and change the allocation according to the period.
I hesitated to put this slide because yes, you should not take these numbers as hard numbers.
Yes,
especially that trend following strategies are customizable. Here, the volatility of the trend index that I used is around 9%, something like this. You can build a trend following strategy with a target volatility of 15, 20% and allocate less to it. So this amount of allocation, the size of the allocation is not something. You should keep you should take the message. Perhaps you should allocate some of your wealth to trend following strategies. Is it 10%, 20%? It depends on which type of trend following strategies you allocate to. But for sure, I would make this allocation constant. Let me show you just something very, very quickly. It answers, hopefully, partly to your question. Is this one. This is, yes, these are all 10-year. This is not my idea. I took this from Winton, which is another systematic hedge fund managers, but I replicated this on our sample. So these are numbers that come from the same sample as the one I used throughout the presentation. Here, you have all the 10-year periods since 1987. Okay, so you start January 87, you go to January 97, and you look at the performance between February 87 to February 97, and so on and so forth. So each line here is a 10-year period taken anywhere over the whole sample period. So these are all the gray lines here for the 60-40 portfolio. In green, you have all the 10-year periods over the period March 2009, when stocks or markets rebounded, to December 2021. Okay? You see that this period, 2009 to 2021, was an exceptionally good period for the 60-40 portfolio. Okay? You have whatever the 10-year period you look at during this lapse of time, during this time period between 2009 to 2021, you have a performance which is in the upper range of your distribution. It's exactly the opposite for trend following. Trend following, over the same period of time, had the worst performance, the worst 10-year periods of all times since 1987. Okay, so saying that you would allocate less to trend following in 2009 because the performance was not that good, this is something you cannot do. You can say, sorry, you can say that after the fact, because you can look at the past and say, okay, I should have allocated less to trend, but this is something you cannot do when you are in 2009, because you don't know what will happen over the next decade. And perhaps just to conclude very briefly, since I'm in the appendices, the gray lines are the 60-40 portfolio. Once again, all 10-year periods from 1987 to 2024. Okay? These are the gray lines. The green lines are when you allocate 20% to my trend following index. Okay? And this one here is the same when you allocate 50% to the trend following index. So just so that you can live with this, how we call this, message. This is what you would get from your 60-40 portfolio over a 10-year period of time, okay? From very high return to a very painful one. This is the impact of adding a trend following strategy to your traditional portfolio, okay? You will never have these huge levels of returns, but you should avoid, you should be able to avoid these very low returns, which are really painful, in my opinion. I think I don't know, do we still have time for additional questions, or I don't think so? Yeah? The very last one?
I'm a bit biased myself, because I always consider that normally we invest long term, and the 60-40 is obviously the number one mandate that banks sell to their clients, but when it's done, it's also done on the long term. So I would personally think that when everybody looks at the volatility, what you've done with Markov, it's on an annual basis, so to speak, but if you invest for the kids, eventually the volatility should have less impact. Everything is not equal. So eventually you would avoid being on the lower part. What I feel is that you have your 60-40, it's diversified, as Markov is want. But because you do the trend, have you tried to do 100% equity because you invest for 20 years and your trend is your actually your diversification? In that case, maybe your green line that looks beautiful because it's in the middle should be obviously boosted because the trend is some kind of a replacement of your bond side, and you could have the equity just with the trend. You have your diversification, and maybe you're not diversifying something that is already diversified.
This is basically what Markowitz did by not investing in bonds at all and replacing all the bond allocation of the portfolio by the trend following strategy. But another message from Markowitz is that the more you add decorrelated assets, the better diversified your portfolio will be. So I would not get rid of bonds because of that. And the next point, and I'll conclude on that, is that I do not expect equities to have the same returns over the next decade. I'm also a long-term investor. I don't know what will happen next year, but you can try to forecast more or less what will happen over the next 10, 20 years. I personally don't think that equities will have the same levels of returns that they had over the past decade or since the global financial crisis. For sure, bonds will not deliver as much as they did over the last 40 years, because we went, if we stick to the US example, if you go even some years back before 1987, you started from rates at 15, 16, 17, okay, all the way down to zero. Okay, so this is kind of a strong tailwind to bonds as well as to equities, as I said before. So for sure, you should expect lower returns over the next decade or two. And it's one more argument, one more positive argument, is an English word, favorable to trend following strategies, in my opinion. And alternative risk premia, because of this decorrelation and this pooling of decorrelated assets that help diversifying your portfolio. Okay, I think we have to stop here. I'm available to discuss anything you feel like discussing. Okay, bonjour.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.